With a 35% movement in mind, let's move on to our next question that came in live. JB asks, if you have a married put on a stock like ROKU and the stock drops 35% overnight before you get a chance to move it, is there anything else you can do? You're looking at almost max loss now. This relates something to I'm putting together for a YouTube comment that came in and says, well, you've talked about a lot of things on the married put, but what do you do on a married put to just move straight down? Whether it's a 1-point movement, JB, or whether it's something else along those lines. Gradual, let's say in the first 20 to 40 days, the stock falls 10, 12, 15%. I'm nearing the maximum loss on the married put position. I still have time remaining, 150, 160, 170 days to go on the trade, but I'm now near full loss. What do I do? Well, in light of that, let me just go here. I'm just going to go to the radioactivetrading.com, the website mainly that talks about the married put approach and the blueprint. And I just want to go in the products page here, take a look at the blueprint here. And I want to go to the table of contents. And so you can just review this real quick, but the reason why I'm going here is that there is a full chapter in the blueprint on exiting the married put or the radioactive profit machine. Time frame, stops, target gain. Do you swing? Do you move? What's your position? And as always, for every income method that's discussed in the married put itself, JB, what is your CEGA model applied to exiting? CEGA model, of course, is our 4-part process for when deciding to use a particular income method over the other. What are the current conditions on your trade? Well, in the dumper, for lack of a better term, in the dumpster there, stocks dropped 30, 35%. I'm near max loss in the position in the first 30 days. Expectations. What's next? Why would the drop occur? Was it related to the stock? Was it related to the market? In this case, it was related to the stock. So what are my expectations? Do I think the stock's going to recover? Do I think it's still going to fall in price? Do I think it's going to just hover where it is right now? What are my expectations going forward? Goals. What are your goals? Well, the goal is to make money. But to make money in a controlled risk position. I'm in a position and overnight some bad news comes out. The stock's down 35%. And I'm at near full loss of 7.5%. I'm happy that I'm only taking a 7.5% loss. Whereas if I had opened it for a covered call for a 2, 3, or 4% premium, I'm down 32, 31, 30%. I'll take that every day of only having a loss of 7% for the protection in place on a stock that I was wrong on. And based on what those are, your goals for the position, conditions, expectations, that determines your action. That's the CEGA model in action, JB, going forward. So I have choices. What could I do? Could I adjust the put? Absolutely. Stock's down 35%. What do I have? I have a high profit in the put. I can lower my cost basis on the total position by moving the put down and keeping insurance in place. But I only do that if the CEGA model is met for that particular income method. If I think the stock's going to continue down, well, I could do another income method number 12 on the position, and maybe turn the position into a profit if it continues to move down. But if I think the stock's going to stagnate and it's just going to remain neutral at its new price, 35% down, JB, I might just take a loss. I'm okay with that. I'm okay with taking a loss of 4, 5, 6% with a stock that went down 35%. Because when I opened the married put, I admitted to myself that I was comfortable doing that position. I was comfortable taking that loss in the absolute worst case scenario. All right, now let me do something real quick here while on radioactivetrading.com. I want you guys to bear with me for a moment. This will take a second to load. Here we go. There we go. Now I'm going to go to my portfolio real quick. We're going to go to the tracker. I'm just going to take a minute to load, JB. It's got to go through the history real quick. And I want to look at some of the major losses. Yandex, I don't know what I did on this one, but you see here the stock was down 7.8%. We made a 1.6% profit. That's not what I'm looking for. I'm looking for the major loss here. Yeah, it's going to go page by page. I'm looking for Penn. Okay, this doesn't show, but we're going to take a look at Penn. It doesn't, I don't know why it, oh, I think Penn's changed. No, it didn't change its symbol. I'm not sure why it's there, but this is one of them. Let's take a look at the details of this married put position. So you see 35 days in the position. We have a 10.3% profit in a time frame where S&P was down 5.7%. As 10.3% profit, 35 days possible if the market was down and we're in a married put, which is essentially a bullish strategy. Initial position. Bought Penn at 33, bought the April 2019 35 put at 420. So this, I'm sorry, this position was opened on 10/2/2018. Had a risk of 5.9%. Yeah, promised a new trade last week, looking for a MACD crossover. Interesting stock, this and that. You know, we write up these things as a nice risk. I'll talk about that on Thursday. So we had a discussion for Thursday, so on and so forth. On October 5th, 3 or 4 days later, I used income method number 12. I decided to open a November short-term put, only about 31 days out in time for $1.45. Penn's at 30.46. Remember, we had opened the stock at 33, so we're down 9%, almost 10% on the position. All three technicals went negative: Bollinger Band, RSI, MACD. Now, PHM we'll talk about in a moment, but I decided to say, hey, I'm going to follow the chart as soon as possible. So I went ahead and bought the November 30 strike put at 145. It's a different income method. Usually I combine this with an income method number 12, so it's free. The 145 is almost completely covered using income method number 6 and leaving the upside open. And then on 11/6, all right, let's go to 11/1. Penn's down at 23.85. I'm down 35% on the position. Cross through earnings. That's one of the reasons why I bought the put, not only because the signals went negative, but because earnings were coming up and I was concerned. The stock bounced a bit today. This was at a liquidation profit of 8.5%. With the stock down 10 points. Okay, let's call it honest, Mike. It's down 9.15 from the original purchase price of 33. So that's down 27%. But we're at a profit of about 8.5%, JB. And on 11/6, we closed the position. And where did I put this? 22.60. All right, so we were down $10.40 from the original purchase price of 33 in 35 days. So we're down 32%, and we took in a profit of 10.3%. Now, that's not done after the drop, right? When it dropped 35%, I could say, okay, well, I've got the 7% loss. I've got the 5.9% loss. I can just take that and move on, depending on my CEGA model described in that exiting the RPM chapter. Or if I think that it's bottomed, if I think it's an overreaction, not shown here, I could have used income method number 9 to take the profit off of the put position, rebalance the trade, and try to get back to break even. All right, but closed at 22.60, sell to close the initial April 35 put at 12.60, and the November 30 put we paid 145 for at 7.45. Stock was down 32%, took in a gain of 10.3%. And again, that was because of concerns. That's because the market trend changed and we knew earnings were coming up. There's another one that we have there. Let me go back here. So Chipotle, I missed this one. This one had a big drop. Let's take a look at the details. That's why I said in those briefs that I missed it on PHM. Closing price on PHM. Stock was at, that was our put strike price. Oh, PHM was at 21.58. We originally opened it at 30.02. All right, so we've got an $8.42 decline. Is that correct? Yeah, 8.42 decline off of stock trading at about $30 when we initially opened the position. It was 30.02. I missed the income method number 12 on this one, but that's a 28% decline. And we took a loss of 2.8% because we had moved up the put beforehand. You said you didn't. What if I missed it? Okay. I was able to reduce the risk here, following the rules in the blueprint, moving up just from the 31 to the 32 strike. generating some premium with the 32 call, and taking in a couple dividends. So, it was okay, but we got out of the position with a loss of only 2.8% on a stock down 28% from when we originally opened it at 30.02 to where it was down to 21.58. I'll accept that. Not every trade has to be a winner. To me, this is a win. Covered call position during the time frame opened on April 10th, 2018, closed in October. 6 months trade, taking a loss of 2.8%. Hey, I don't like to take losses, JB, but it happens. Not every trade is going to be a winner. I managed it correctly as I could using the income methods in the blueprint. Stock was stagnating for a while. It was dropping. I could have rolled down, but I didn't have the strong expectation. That point, it's just time to get out of the trade. It's perfectly fine. Had I done a covered call over 6 months on Polte here, what is this? 40 cents premium on a stock trading roughly around $30 at the time. Now, as a shorter term probably trade, it was June 7th to June 22. So a 15-day trade. So about 1% every 2 weeks. 2.5% per month over a 6-month period would have garnered about 12%. Let's just call it 16%, 2.5% over that 6-month period, about 15%. In a covered call position, I still would have been down 13%. With the stock down 28% and I generated 15. We'd still be at a loss of 13% of what we invested. I will take this every day. I don't like to lose. You and I have had that conversation before, but I'm in this strategy because when losses happened, I'm in control, and I was close to even getting into bulletproof status on this position. So you would want to determine, we had that discussion last week, if I'm not mistaken. Let's go ahead and go over to the YouTube channel, take a look at this. These discussions here, adjusting the protective put and a married put, and talking about rolling it down, when to exit a married put position. That's all described, of course, in the blueprint. There are ways that you can manage that. There are ways that you can control that. There are ways that you can catch that. And there's that full chapter in the blueprint on when to exit the RPM as well. What are my 3 options in a position like ROKU, where if I opened it 2 or 3 weeks ago and now the stock has completely declined 35%? And as you mentioned, it declined overnight. And this drop here. Well, honestly, if I was in a married put back in this time frame, bought the stock, let's say at 95, I might have had the 110 put, for example, and I might have had a risk as ROKU. So we're going to say about 7.5 to 8% on the position. When this initial move happened, this downturn here, possibly even right here, what did I mention with that other trade? I saw the 3 things go negative: the Bollinger Band, the MACD, and it dropped below the SMA 20. So I might not have caught it here, but I would have had concerns. But now here, I definitely have concerns. Volatility is high. I might have paid a high price for that income method number 12, the extra put. And whether I went 1 month out, 2 months out, or 4 months out with an extra put, I might have been at a profit here on that position, JB. That's highly possible. Or I probably could have exited it here. Assume my put was way out here when I got into the position, even at the peak here at 100, so maybe it would have been at the 115 or 120, depending, but still only an 8% risk. Here with this drop and an increase in IV, still 6 to 7 months to go on the put, this probably would have only been a 2 or 3% loss. I might have just exited that position on that crazy day and been done with it, taken that profit and move out even further. Well, I'll talk about that in just a moment, JB. So how do you pick the strike price of the put? That's all discussed in the blueprint. Our preferred structure following the 3 core principles of radioactive trading: the at-the-money bell curve, proper position sizing, and, of course, the radioactive decay line. We don't get involved in delta. You don't need to. It's the risk control. And what's good for me might not be good for you. In this position here, with stock at trading, flirting with 100, I'm going to look for risk personally. My personal preference in the radioactive trading technique of under 8%. I usually like to target around 6.5 to 7.5% at risk. On a more volatile stock, that might be 12, 15, 20% in the money. On something like IBM, I could probably go 8% in the money. and have this, or I'm sorry, I could probably go right at the money and have this risk, but I go 2 or 3% in the money, I'm only at 4% risk. We have our preferred structure discussed in the blueprint of what we like to choose, what risks we look for, whether it's a volatile market, whether it's a calm market, things of that nature. But it comes down to personal preference. What do I mean by personal preference? Our default searches that we live by, that we swear by, those trades that I just showed you in the Fusion portfolio, these are 95% of those trades that are posted there come directly from this default search, radioactive, sorted by earnings per share growth. But there's, and here's the risks. 8.2, a little bit too rich for my blood. 7.8, hey, I get midpoint, that's probably in my wheelhouse. 8.5, a little bit high, but in a higher volatile market, we were opening married puts that had risk of 8.5%, 9%, because that's what the market was offering. And I'm still keeping it into single digits. And you can see right here, what puts are we selecting? Hey, we're looking for that controlled risk of 6 to 9.5%. We're not going more than 20% in the money, because you go deeper in the money. And there's webinars on this too that are archived. You can if you look up the married put and strike price and so forth on the YouTube page or on Radioactive Trading even. Hey, if you've got a more volatile stock, you've got a choice. Either you take a higher risk because you're bullish on the position, you want to trade it as a married put, and you keep in this 10, 12, 15% in the money range, or you've got to go 25, 30, 35% to get a controlled risk of single digits. That's what's discussed in the blueprint. Now, this links directly to Robert's question. Robert said, is there a way to see married puts across multiple days to expiration on the same page? I'm assuming you're meaning for underlying security. And that's one of the 4 steps I do. So I come into this search. I pull up my radioactive by earnings per share growth default search. I look at my results. Allscare Health is one I had a discussion with today during a coaching session. And Tidewater, this is one I'm actually considering opening as well. Probably should have opened it last week when we were discussing it on the webinar, JB. But look, I've got Oscar Health. I've got the October 21 strike with a risk of 8.9%, a little bit high. It's in the range that I want. It's right at 20% in the money. If I go 25, 30, 35%, what am I doing? I'm kind of taking away the expectancy of potential profit. But the deeper in the money you go, the lower your risk you have. Why am I not opening a married put that's 50% in the money, only has a 0.1% risk? Because the expectancy of any profit is too low. I've hedged myself completely out of the position. So what do I do here? Well, I'll look at the stock chart, company information. I want to make sure there's no recent headlines that have come out. I'll take a look at the profit and loss chart, run my what if scenarios. And then, Robert, what I'll do is click on search by symbol. And currently here, this shows me the October expirations. What happens if I go a little bit deeper in the money than I want to? Well, I get the risk of 7% that I want, but am I too deep in the money now, removing expectancy of profit? Why didn't the 20 strike come up on a stock at 1756 or the 19? Because the risk is too high. It's out of my bounds. It's out of that single digit that I want. But Robert, when you're on the search and you link to the search by symbol tool, you can see the various strike prices or different expirations. Or you can even go into the search tool itself and just look by symbol. Back on the search tool, I can go in the fundamentals and look by symbol and remove the one result per security. And this is OSCR. And this will show me any of the married puts that match that criteria that I want with the risk that I want, and it's still only October 21st. But let's say I bump this up to 15%, lower this to 3%, and allow it to go 40% in the money. There you go. Now I've got December's, January's, November's, different strikes, different expirations, risks I don't want, risks I do want. All right. So JB, you can glean right from the default search. I'm sorry, I stepped over myself, but you can see right from the default search. Here's something that always comes up. We've got our criteria, and someone says, well, what delta do you use for the put? I don't. And why don't I? Because I don't need to. Everything works hand in hand. I'm looking for stocks with certain technical and fundamental criteria that have a controlled risk in the time frame that I want. Without screening by delta, The first 15 results here out of 19. I have a restricted delta range of 0.43 to 0.55. And sometimes this is more along the lines of 0.48 to 0.65. But without even using delta, we're restricting. What about implied volatility? Does that matter? Well, it comes into play. We have discussions on that in the blueprint as well. But look, without even using an implied volatility filter, the results are an IV of 0.3768, that's the low, to 0.7239. You're not seeing anything outlandish. You're not seeing anything out of bounds. Because the structure of the trade, the stocks that we're looking for, without even using delta, without using implied volatility, it's already factored in. The risk factor, the determination of not going too far in the money to restrict expectancy, not going out of the money where you're taking the double-digit risks, that's all accounted for. I don't need to filter by delta. You absolutely can if you want to. I don't need to filter by implied volatility or implied volatility range, but you absolutely can if you want to. That's there for you. But our selection process is shown right here. Now, in addition to that, this is the radioactive results that we would look for sorted by the highest earnings per share growth. That's earnings preferred filter. But there's also the default of sorted by risk. I want to see similar stocks, but I want the lower risk positions. We see Pan American Silver comes up, but it's the lower risk. It's not the 8% risk, it's a 6.3. The one we were looking at is totally removed, Oscar Health. But here's a Tidewater one. Same stock, slightly deeper in the money for only a 6.8% risk, where the other one, which was allowing for more risk, if I'm not mistaken, was the 8.5% risk further out in December with the same strike. We have blueprint owners that follow just the sorted by risk for the lower risk control up front. We've got blueprint owners that just follow the earnings per share growth. 95% of the trades we post in that Fusion portfolio come right from here. And we have, of course, naturally blueprint owners who've made adjustments to the fundamental and technical criteria and the range and risk as well to match their specific goals. The blueprint is a guideline to learn the full approach, the various income methods, controlling risk, exiting the position, and much more. But tweaks can be made internally. You can make tweaks to this search based on your goals, your risk threshold, and what kind of securities, JB, you're looking for as well. All right, so remember, the full information, the full content, of course, is available in the blueprint. It goes through the full structure and setup, all 12 different income methods, full chapters, appendixes on managing the positions, exiting the married put position, combining income methods, and much, much more. You can check that out here at PowerOptions or go to radioactivetrading.com and click on the products tab there as well. Different approaches that are used in different markets, the CEGA model for each of the individual 12 income methods, and much, much more.